Welcome back to OK Computer. I am Dan Nathan. I am joined by Ethan Agarwal. He is the co-founder and CEO of The Coterie, and Ajay Kamat. He is a partner at Pear VC and an early investor in Ethan's company, The Coterie. Welcome, guys.
Hey, thanks for having us.
Thanks for having us, Dan.
All right, really excited about this. You guys are you were an early part of the Funders and Founders series that our friends over at RBC Capital are hosting here. And the whole idea, and you guys have probably heard a couple of these already, is put together some founders of some really interesting companies, things that we think are relevant to our audience. And the folks that kind of saw the vision for those companies early on. And you guys are a really unique combo because it's not just the Coterie, Ajay, that you invested as far as Ethan is concerned, but his first company, Aptiv. So I'd love to kind of set the stage a little bit. Ethan, maybe you want to kind of talk to us about your background before we got to the founding of Coterie, because again, you were a two-time founder here, and looking at your bio and talking to you, you and I met at Money 2020 in the fall, and I got to hear the story back then. And at that point, I was fairly well convinced this would be something that our listeners would be interested in hearing about. So talk to me a little bit about your background, and I'd love to hear a little bit of Ajay's also.
Yeah, sure. Well, thanks for having me, Dan.
Yeah.
So prior to the Coterie, I was the founder CEO of a company called Aptiv, a digital fitness company. Our office was 2 blocks from here. What we did is we created audio-based workout content. So the easiest way to think about it is like Spotify, but for fitness.
Mm-hmm.
So we charge $10 a month. You get access to this large on-demand content library. And our thesis was that audio is actually a better delivery medium than video for certain kinds of workouts, because you don't want to be staring at your screen when you're doing yoga or running down the street. So instead, we provided guidance, music, motivation just through audio. And if you look today, every major fitness company is doing audio. We were the first ones to do it back in 2016. So I ran that company for about 6 years. We grew it to 100 million of revenue. We had 1 million paying subscribers in 20 countries. Reasonable sized business. And then after year 5 or so, the LTV CACs were getting tough to maintain because CPMs were going up in all the regular platforms, and CTRs were, up, but not significantly. And so the CACs were spiking. And so we said, we need to figure out distribution. And so we ended up selling it to a private equity firm in Q1 of 21. Prior to Aptiv, I was at McKinsey for 3 years in the finance practice. Before that, I was at a hedge fund. It was a merger arb fund. It was a really interesting fund, taught me a lot about public markets investing. I did my MBA from Wharton, and I started my career in investment banking. So I actually spent like 10 years or so on the finance strategy side before starting my first company, and have now been doing startups for the last 8 years or so.
Yeah. So, and Ajay, you started out as a founder and found yourself to be an investor. Talk to me a little bit about your background.
Sure. Yeah. So I'm a partner at Pear. I've been at Pear since 2015, so just over 8 years now. I'm a generalist investor, but Pear, we really specialize in pre-seed and seed investing. And the way that I got into Pear was I was first a founder. I was a founder of a consumer company called Wedding Party, and Pear was actually one of our very early investors. So after we ran that company, grew it, and then ultimately sold it, I joined Pear as the first partner on the team outside of the founders. And at Pear, I really focus on our pre-seed investing. So I really specialize in, 2 people and an idea. And a lot of what we do is focus on, the person or the founders that are actually starting the company. And that's kind of the genesis of how I started working with Ethan.
Yeah. So talk to me a little bit about like when you had this second opportunity, and we're going to get to the Coterie in a second, like when you knew that he was going to do something else, you were all in once again. Like, is that something that has been consistent through your career as a VC, or since, dating back obviously to 2015, have you invested in a one founder on multiple occasions before?
Look, starting a company is super, super hard, right? And we invest in many first-time founders, and sometimes they're successful, but many times they're not. We find that people, they learn a ton through that first experience. And if they still have the desire and the drive to start another company, they're starting off with like a big step up from the first time around. So we try all the time to back founders that we've previously partnered with because they're just significantly more in tune with what it's going to take to get a company off the ground. And the second Ethan started, calling me and ideating and talking about new concepts, I called my partners and said, look, Ethan's going to start something. We have to be the first person to write a check. And as soon as he was willing and able to take our capital, we made that happen.
All right, talk to me a little bit about that process. Okay, so you have this, the successful business, you sell it to private equity, you probably feel like pretty good run right there. Did you want to go right back into starting a new company? And then what were some of the ideas that you were kicking around at the time?
Well, so this idea for the Coterie actually came to me probably 2 years into my first company. Not as refined as it is now, but there was a problem that was sort of stuck in my head, and I said, someone has to solve this. And then fast forward 4 years later, I sold Aptiv, and I found myself with some free time, and turned out no one had solved that problem. And so when I sold Aptiv, first of all, I think it was a great experience and a great journey. I consider it a double, maybe like a triple. I wouldn't consider it a home run, definitely not a grand slam. So I didn't walk away feeling like I'm done. I felt like, I have more to prove. There's more I can do in this game. And so I just had this itch to start something. I told my wife I would take a year off. It ended up being 6 weeks. And we recently had our second kid, and I was texting Ajay being like, hey, I'm kind of floating this idea. And then, a couple weeks later, I incorporated it. Because we can get to this, but I think Ajay will tell you, and at least my 2 cents is, the people that should be starting companies are when you can't wake up without thinking about that thing, right? And so if I found myself repeatedly waking up thinking about that thing, then it's an itch that needs to be scratched, or it's like a thorn in your head and you're like, I got to go resolve that problem. And so you can take a week or 2 weeks or a month off, but ultimately you're not going to be satisfied until you go solve that thing.
Yeah, it's interesting because, you and I have talked about kind of the impetus for starting the Coterie, and it wasn't one of those things where you were looking out at an existing business and saying, there's something wrong there that I think I can kind of attack maybe through software or through some sort of different mechanism. This was a problem that you had in your own life about the way you were being serviced, right, in the financial services industry. So talk to me a little bit about that. So you said that this was a problem that you had when you were Aptiv, and you just didn't have a whole heck of a lot of time to focus on it. So what was the problem, and kind of how did the business model evolve?
Yeah, I could have taken the Elon Musk approach, I guess, and done 5 different companies at once, but I don't have it in me to do that, I guess. So what happened is Aptiv was growing, and company was doing well, and I turned off my salary and I went to apply for a mortgage. And the guy says, we can't give you a mortgage, you don't have a salary. And I said, well, if you look at my cash and my assets and equity and everything, clearly I'm not going to default. But they couldn't figure out that someone without a salary could afford a mortgage. And then I remember thinking to myself, almost everyone that I know makes a lot more money from their assets than they do from their salary. And those assets can be alternative investments, they could be carry, they could be equity in a startup, whatever it is. But our salaries tend to be a very small part of our total package or compensation. And so the fact that, a very large institution hasn't come to the point where they realize there's all these people making all this money that has nothing to do with their salary, and salary is actually a really bad way of assessing the risk for that group, said to me oh shit, there's an opportunity here.
You can say shit.
Okay. Oh shit, there's an opportunity here. And so that was frustrating to me. And then a couple years later, my wife and I went to speak to a wealth manager, and, the guy does his whole sort of song and dance, and he gives us literally a binder, and the binder has a portfolio recommendation of 60-40 stocks and bonds. I was like, this is ridiculous. I was 33 or something at the time. I had hopefully 50 plus years ahead of me. I have no interest in doing 60-40, and I'm certainly not paying you 50 bips to do 60-40 for me. I'm interested in learning about crypto, and I want to LP into funds, and I'm interested in real estate. There's a whole bunch of stuff I want to learn about, but this top tier bank that employs thousands of financial advisors couldn't figure out how to target me as a demographic. And so those two things, put that thorn in my brain. And I was like, hang on, there's got to be a better way to build product to take care of the finances for people who make more money from assets than salary. Ajay is an investor, right? Investors make most of their money from their carry. I'm a startup guy. Every startup person I know makes money from equity. So how come the big institutions and the large banks are not focused on delivering products to us? That was the question that I couldn't answer. And as I did more research, I realized no one is focused on that. And so that's where the Coterie came to be.
So Ajay, when you were talking to your partner, said, we got to back Ethan, was this an idea that resonated with you and your partners? Because I suspect that at some point in the not so distant past, you guys were all faced with some of these similar sort of dilemmas as from the banking system.
Yeah, look, I mean, I think that this cohort of potential customers that Ethan was talking about doesn't represent like the majority of the country, but certainly in technology and in venture, it's everyone that we knew, including ourselves. And so it was like very visceral when he explained the idea to me. I was like, yep, like me, my siblings, all our friends, in this industry face these same challenges. And at a minimum, I thought, okay, this is a great entry point into this ecosystem, and we can start here because this is an untapped market.
Here we are. You got lots of good feedback about what you're trying to solve here. So how does the business model evolve? Because again, you just said you didn't want to pay a wealth manager 50 bips for a traditional 60-40. You had to come up with a better mousetrap, right? Yeah. And I'm assuming you did not want to employ, herd, the thundering herd, going back to, Merrill Lynch and the like here. This was going to be a tech solution.
Yeah, that's exactly right. So first of all, this is a software company. We are not a wealth management company. We don't do any kind of advisory work. We don't employ advisors. We employ software engineers, product builders, designers, and all of our products are software only. The way the company has evolved is actually really interesting over the last 24 months. So we started with a realization that, personally, that when you invest in alternative assets, and by that I mean LP into a VC fund or a private equity fund or hedge fund or whatever, that world is stuck in 30 years ago. So you're, for those of you who aren't familiar with it, it's a lot of PDFs uploaded to portals that look like they were designed in 1996, and you're paying stuff manually and you're getting reporting manually. And it's okay if you're, Ohio Teachers Pension Plan or some massive organization, but there's been a spike in the number of people that are LPs in alternative assets, specifically within our demographic. So it's not just large institutions anymore. It's individuals like, the 3 or 4 of us that are talking right now. And so what ends up happening is we can't assess the value of our investments properly. And that's insane because the majority of our wealth is in these alternative assets. So that's one side, the problem of the LP side. We've also understood there's a problem on the GP side, which Ajay can probably talk about, which is managing your LPs is actually a massive pain in the ass. And so what we decided is we're going to build a series of products that help the LPs of alternative assets and the GPs of alternative assets. And there's demand on both sides to solve that problem. And the legacy businesses we're fighting against, so to speak, are very domain focused and are not thinking of it from a holistic perspective. So you'll find solutions that do part of each of the things that we do. So someone that does KYC, someone that does subdocs, someone that does capital calls, someone that does a portal. And as a result, you have LPs like myself. I'm an LP in 7 different funds. I have to log into 4 different portals every time there's a new file or quarterly report or K1 or capital call. And I don't have a guy that does it. I just do it myself. We have a guy on the platform. He has 80 different fund investments and he doesn't have a guy. He just does it himself because it's a massive pain in the ass until he found the Coterie. So we solved that problem for the LPs. I think Ajay can probably explain to you what that problem looks like for the GPs.
Yeah. So again, on the GP side, it's kind of interesting because you just talked about this is not, a TAM that most VCs are probably that attracted to, right? But it has the potential to get really meaty, and now it's a 2-sided market for that matter.
Well, sorry, Ajay, but so on the TAM point, I think that TAM from an N perspective is not massive, but the TAM from a dollars perspective is fucking huge, right? The alternative assets industry is $12 trillion. And so the reason the TAM doesn't look big is because the number of people is not that much, but the dollars at work is massive, right? So there's 25 million millionaires in the United States. About 3 million of them are under the age of 40. And something like 60% or so are allocating dollars to alternative assets. So we're talking about, call it a couple million people, but the LTVs of these people is massive. And the best comp for this is there's a company called Personal Capital from a couple of years ago. They got bought by Empower Financial. They targeted people that had only $100,000 of wealth and above. So they're even sort of down market from our audience. But they sold for $1 billion and they had 22,000 customers. So that means they're ascribing a $50,000 LTV per customer for that demographic. And our demographic is on the higher end, and we aspire to have significantly more than $22,000. So we can create a multi-billion-dollar company with just tens of thousands of customers because the LTVs are so high.
Yeah, and Ajay, tell us about the experience on the GP side of things, because I'm sure any opportunity that you have to make that user experience for your LPs a bit smoother, it's something it's kind of less of an admin burden for your fund, and you guys can spend more time on the things that you guys like doing the best.
Yeah, exactly. I mean, we want to spend as much time with founders as we possibly can, not dealing with all the back office management, focusing on managing the LPs, the capital calls, the subscription docs. And that's truly like a pain, right? So to give you a sense, we have both large institutional investors and many individuals. We have friends and family. We have, folks in our network, other founders that want to invest in Pear. Managing those individual LPs is a huge pain, right? So you have to get every single doc from all these individuals. Capital calls are a mess. We have to do them all manually. And just to give you a sense about how bad it is, like even me and my partners miss our capital calls all the time. And it's not because we don't care. We care a lot about our fund. We're just super busy, and our finance people have to call us and we feel like horrible that we miss these things, but they're just like bugging us all the time. And it wasn't until the Coterie where we could take all of our funds and all of our capital calls, put them in one place, that this process started to become significantly easier. Mm-hmm. And there's just no technology on the back end that we were really using. And the Coterie really enables a completely different experience.
Yeah. So Ethan, let's talk about this. I heard you on Bloomberg TV, I think it was a few months ago, and it was a stat that I just thought was pretty astounding in a way. So it was talking about individuals, okay, and just kind of, you had some data around how they're looking more towards alternatives. To many folks who are sophisticated accredited investors, the idea of a 60-40 equity, fixed income portfolio is not that interesting, especially when you live in a world and before, let's say, 2022, this ZERP world where alternatives, were benefiting a great deal, sure, right, from this low interest rate environment. But you said something, I think it was KKR, you said that their incremental or the subsequent raises, they're looking for 40% yes, from individual investors. That actually absolutely shocked me a little bit. And so that just speaks to, I think, the platform that you have built and the opportunity that you're allowing individual investors to kind of access those markets in a way that it just would have been, I don't know, it would have been really cumbersome, I guess. And that's the experience that you had. And you had access to those investments. But it really became a cumbersome, kind of way in which to manage them.
Yeah, so you're bringing up a great point, which is that the demand is happening on both sides. So individuals who are LPs are looking to invest in alternative assets, but the GPs of places like KKR, and by the way, it's Apollo, it's Blackstone, it's all the large asset managers. One fund manager who's responsible for fundraising at a $100 billion fund told me he's about to raise a $20 billion fund, and he expects 20% of that $20 billion, so $4 billion to come from individual investors. And they don't have a single dime from individual investors mm-hmm. today. So it's the full gamut of GPs that are looking to individual investors for their next set of funds, or at least some percentage of it. And why is that? So there's a couple reasons. One is the traditional LPs, institutions, pension plans, et cetera, you could argue are tapped out because they're only allowed to issue a certain percentage of their portfolio to a specific strategy. Mm-hmm. And when the denominator falls in terms of all the valuations in the last 48 months, that means that their numerators are kind of screwed up. And so they can't allocate anymore to the traditional sort of venture private equity firms. So that means that if you want to raise more capital, you have to look somewhere else. And 24 months ago, prior to the Coterie, prior to a few other companies, access was a big problem. You couldn't get access to these large, high-quality alternative assets, mm-hmm. Asset managers. And then the Coterie came along, and I'll give credit to a number of other companies like Allocate and Titan and a few others that have also provided access to these large alternative assets. So I don't think access is the differentiator anymore. Now the differentiator is the process, mm-hmm. because as Ajay and Pear don't want to spend time dealing with paperwork and bullshit. Mm-hmm. KKR and Apollo and those guys definitely don't want to spend time dealing with that paperwork and bullshit. And so that's where the Coterie comes in, is we say, we will not only help the LPs manage their investments in you, we will help the GPs take care of all their KYC and subscription documents and capital calls and reporting. And most of the time, by the way, a lot of these large funds, not to get into the nitty gritty, but they don't have an external fund manager. They're actually doing it themselves. Mm-hmm. Or excuse me, fund administrators. So they're doing it themselves. And so they have these massive finance teams that are doing an inordinate amount of just like manual human work that should be done by software, not only because it's faster and cheaper, but also because it's better. And that's where the product really shines.
So talk to me, again, this is about a year ago. We had obviously SVB, First Republic, Signature. We had a handful of banks that service this community that you're talking about, not on the GP side and the LP side. And I'm just curious because you probably for a whole host of reasons, whether it be you, Ajay, at Pear, you guys were probably right in the middle of a bunch of this. I know it was a very harrowing time for a lot of folks. Talk to me about what that period, like the validation of this platform. I'm sure it made the lives of many folks a lot easier if you were on a platform like the Coterie versus, let's say, somebody who has, a dozen, VC or, other LP investments, just spread out all over the place.
Yeah, I think what this speaks to with the SVB debacle is there's value in having a software product that aggregates all of your different positions as opposed to relying on one place exclusively. So I'll give you a perfect example. So people pay capital calls to our platform, and several of the funds that are GPs on our platform used SVP for their banking. And what happened is when SVB went down and people changed their bank accounts to receive the capital calls, they were getting their capital call dollars really late because the LPs had not changed the routing of where the money was supposed to go, except if they were using the Coterie. Because every time there's a new capital call issued, we refresh the source destination of the capital account of the capital call, because it's software that's doing the scraping and that's ultimately sending the money. So the LPs that were on the Coterie were sending their money to the GPs much faster and much more accurately than the LPs that were not on the Coterie. And it's just one of the many examples of why bringing sophistication and technology into this industry is beneficial for both parties. We're not just servicing the LPs or just servicing the GPs.
Yeah. All right, let's get down to some other stuff here let's broaden out the conversation a little bit. Now, Ajay, I'd love to kind of get your sense, because I know, again, as somebody who built a company and sold it to a very large company, and now you're an investor, you focus on pre-seed and seed. What is it like to, meet a founder? And obviously you already knew Ethan, but to kind of invest at such an early stage. And then, what you did your Series A, I want to say a year and a half ago or 2 years ago.
2 years ago.
And so have, an Andreessen and lead that round and the sort of VCs that participate. What is that like for you as somebody who kind of sees something and you get to that period? And I know this is obviously something that you've done again and again and again, and you've had these sorts of validations. Just talk to us a little bit about that, because again, it is a very nice stamp of approval at when you got to a certain scale here.
I'm a very lucky person. I think the best job in the world is to be a founder. I think the second best job is to partner with founders, and because we get to work with these people who are visionaries and really trying to create something out of nothing. And Ethan is really one of these types of founders. Let me tell you about, when I met Ethan working on Aptiv. I obviously knew him before that. We were friends, but we weren't really colleagues. We had never worked together. When he wanted to build Aptiv, he was one person, and his first, minimum viable product, the first thing that he put out there was he recorded these classes himself, and he was sending it to his friends. And, the quality, I have to say, it wasn't very good, but
a lot of huffing and puffing, or what?
It was terrible.
Yeah, it was terrible. And you could hear the dog barking in the background. And it was just kind of like, a first attempt. Let's just put it that way. But people absolutely loved these classes, right? And he had like dozens of people coming up to hundreds of people paying for these like relatively low quality classes. And that told me that there was really something there. There were two things. There was something in the product, and there was something in this person, that he was really putting himself out there with very little resources, and he was connecting with customers. So, we were fortunate to partner with him on Aptiv, and it grew incredibly well. And, when he started the Coterie, he just had this idea. He didn't even have a slide deck. We just talked about it a couple of times. I helped him actually put together the first slide deck to raise the additional capital after Pear. But for us, his insight on the customer was so clear. He had thought about it so deeply that it was clear that it was worth making a bet to see if he was right. And and I think he got this. He started building the team, and he got the product out there and got some early customers. It's really a joy to see these companies grow, and it's been incredible to see the company grow. But at the end of the day, I think Ethan and I think the same, that a company that's growing isn't the end goal. The end goal is to build a massive company that withstands, time. It's there for decades. And that's what we're all trying to do together.
Ajay, I think, is right that founders do have one of the best jobs in the world. So I knew Ajay previously, but what was really, so he was a founder prior to joining Pear, and he started this company, and I was working at McKinsey or something at the time. And I was watching him on his journey, and I was like, oh, this is such a different thing than me, and I don't understand how he's doing this. And then when I started like thinking about my thing, he was the only rational guy I would go to, because he's one of the best product people I've ever met. So I had to go through it and really like flush it out for 2 years. It was nothing for 2 years. And what was fortunate is that he was the first guy to support me in any way. Like I've said this publicly before, but I had like 120 meetings of no's prior to getting my first yes, which was him.
Yeah.
And even though we knew each other before, you don't make investments like that just based on like, I know this guy. Like there has to be something there. And it was Ajay, I think it was your first investment at Pear, is that right?
It was, I had just started.
Yeah. So it was his first investment in a new job. And so I was just so grateful that someone had finally sort of, believed in me to make this thing something real. And so like, you're right, Dan, that, once things start catching fire, everyone comes in.
Yeah.
You never forget the people that were there early. And Ajay has been there early twice. And, I said Aptiv was a double, not a grand slam. So I think Pear did okay on it. It wasn't, they've invested in Dropbox and all this other stuff. It wasn't that scale of success. And so the second time came around, naturally, I'm sort of just like throwing ideas around with him frequently. But then again, when it was time for me to start my second company, it was like, there's no one else I'm going to go to for the first conversation. And then I was fortunate that they saw it on their side as well, right? So like having someone in your corner, whether things are up or down, especially when no one else sees it, is so rare. And you just got to be so fortunate and grateful to be in that position. And then what happens is, what you end up doing is like, so Pear as a firm, I think what they do particularly well is they focus really on the person, because they focus so early. Companies change, ideas change, this and that, but they find people and then they support them. And so they've been a supportive investor in like Ethan for a very long time. And you don't find that easily everywhere. So it's been incredible. If/when I start another company and another company, they're going to be my first call every time. And I think the testament to these guys is how quickly they've grown since I first started working with them. I mean, he was the first non-founder investor there. And Ajay, what's the team now? You guys are like 30 people or something?
Yeah, we're now, at the time we were investing out of our first $50 million fund. Now we have 30 people. Our latest fund is a $432 million fund. We're early investors in Dropbox, in DoorDash, Gusto, Avanta, Garden Health, The Coterie. So we're very fortunate.
Well, let's talk a little bit about the environment. It's early February when we're recording this here. The NASDAQ is basically at all-time highs. The S&P is at all-time highs. We've spent a lot of time on the podcast over the last couple of years talking about the sort of lag that the private markets have to the public markets. I had a conversation with my friend Rick Heitzman of First Mark Capital and Alexis Ohanian of 776. We just dropped that in the feed. It sounds like there's some kind of activity brewing a little bit. There's a little movement. We saw all the data about, VC and deployment and valuations and the like. And, obviously there was this huge rush in 2023 towards anything that was AI related. And it felt a lot like a period that I recall in the turn of the century where you could have been, kind of like a stodgy little tech company and you put a .com on the end of your name. There's a lot of that going on, right? And we saw it. But what was different this time is that the scale of these, pre-revenue companies that they were raising at and the valuations and, that kind of, I think, sucked a lot of the air out of the room. All right. But now it feels like there's some stuff happening, right? Things are loosening up a little bit. Talk to me a little bit about that. Maybe Ethan, I'll start with you because, that's an encouraging sign because it's kind of been a long couple of years, I think, in the private tech markets here.
It has been. And a couple things I'll say. One is, one of the, Ajay spoke about the benefits of being a second-time founder. One of the benefits is you're a lot more disciplined with your runway and you're a lot more disciplined with how you hire your team. And so we raised our last round of funding 2 years ago. And, it was a pretty big round, and we had sort of several years of cash. And there was an argument to be made that, okay, you should pour fuel on the fire and just grow like crazy.
Mm-hmm.
And, some of our peers did that. They hired significantly in 20 and 21, and then suddenly 22 comes, and you can do cuts and stuff, but like, you're kind of fucked at that point.
Mm-hmm.
There isn't a lot that you can do at that point. So, I'll I guess take some credit here is like I managed our burn very, very carefully. So even though we haven't raised money for a couple of years, we still have another several years of runway if we don't generate any revenue and we don't do anything going forward. So I think disciplined approach to managing capital is critical in tough times and even when times are looking good. And the other thing I'll say is like, I think you generally have to build a company with the thought that you're not going to know where the market is going, right? So if 24 ends up being a great year, great. Like maybe our growth will be higher than expected. But I don't think any of us thought 23 would be the kind of year that it was. And we probably also didn't think that 22 would be the kind of year that it was. And so I'm not going to be in the business of being a macroeconomic expert and trying to guide my startup to where I think the economy is going to go. I need to be building products and targeting distribution that is agnostic. And maybe I get some fortunate benefits from like beta of the market rising, or maybe I get dinged a little more of beta with the market dropping, but I have to focus on alpha, right? Like I'm not, even though I'm a startup founder and I'm a CEO, ultimately I'm an allocator of capital, right? I have a set of resources, dollars and team, and I deploy those to build a return. And so my job is to figure out how to generate alpha regardless of beta. And so I think founders that try to time the market, do things that are fun when the market's up and pull back when it's down, but like that's on the 10% net margin. You really got to run your company as if you don't know what's going to happen because you don't know what's going to happen.
Yeah, and I think you alluded to that as a second-time founder, what you learned from the first experience. It seems like you operated after that Series A with a great deal of discipline too, which it took out a lot of the margin for error as far as the macro is concerned. So that makes a lot of sense.
Yeah, I remember the board meeting where Ethan and the board decided to make the changes to the runway and the plan. And I have used that example with every single portfolio company in the year and a half since. And it was extremely prudent to do that. And it's incredible the foresight that Ethan had there.
Yeah, as a pre-seed and seed investor, were you and have you you've been through a few different cycles now since you've been at Pear. Are you less sensitive to some of the things that Ethan was talking about on the macro front? Because again, it sounds like you're really picking founders, right, with great ideas that you have confidence are going to be able to execute.
Okay, so the good thing about being at the very early stage is that in any particular moment, we're insulated from, mostly insulated from the macroeconomic situation because our companies take 10 years to build. That being said, we have many investments and we have later stage investments as well. And so for those later stage investments, we do need to go in and really think about what does the current market look like? What is it going to take to raise additional capital? If there's no additional capital on the table, how should we plan? And so we actually have both sides that we deal with at Pear.
All right. Well, listen, guys, we covered a lot of ground here. It was really great to kind of go deeper on the Coterie. It's interesting because when I met Ethan in the fall at Money 2020, it felt like there was some stuff brewing a little bit in the fintech market. And obviously, the follow through that we've seen in the public markets, the follow through that we've seen in the economy, it just seems like that the private markets are about to pick up a little bit here. And so that's encouraging, I think, for everybody, who are listening here and the like here. But I really appreciate hearing your guys' individual origin stories and how you guys came together and how you did it again. And I look forward to the opportunity of following up on it. So guys, thanks a lot for being here. I really appreciate it.
Thanks for having us, Dan.